This is an apartment list survey. Rising housing cost, a more salient political issue for renters. Now, this really tells us a lot. So renters are much more concerned, and making it a political issue, the cost of housing, right? Why aren't homeowners as concerned about this? Well, I think there's a whole variety of reasons. But one reason, of course, is that when you buy a house, if you got a 30-year fantastic fixed rate mortgage at the lowest rates in 5,000 years, and you have 28 or 29 years left on that mortgage, and you're very unlikely to ever give that mortgage up, no matter what, you're going to try and keep that mortgage because it's such an asset, right? And I just want to make sure we distinguish this again. I have mentioned it before, but it is critically important. The market value of a property is not the same as the value of the property with the included mortgage to the current owner. In other words, the market value of a property might be $500,000, for example. But to that current owner that has a mortgage of 3% or 3.5%, that property is worth a lot more than $500,000 to them, because that mortgage is a big part of the asset and it's immovable. The new buyer does not get that mortgage, only the current owner gets that mortgage. So this is kind of similar to what's going on with the rental housing market. And why is it that 29% of renters strongly agree that housing affordability is a critical issue in the upcoming midterm election? Well, only 14% of homeowners, less than half, think this is such a big issue. And then when you go down one notch to the just agree rather than strongly agree, now, again, these are surveys, they're not totally empirical, they're humans, like, do you agree, or do you strongly agree, or do you slightly agree, or whatever, right? But look, when you do it out over enough numbers, you have that law of large numbers working for you, and you can glean a lot of data from these surveys, right? So for agreeing, 25% of renters agree that this is a big issue, and only 19% of homeowners agree. Okay, what about the second question on this survey? In the past year, rising housing costs have had a negative impact on me and my family. Only 12% of homeowners said this, but 27% of renters said this. Wow, that was strongly agree. Now, just agree, 14% of homeowners and 22% of renters. So clearly, no matter what way you slice it, and you don't even need a survey to know this, right? Renters are far more concerned about affordability of a house. And this doesn't mean to buy a house. It just means to rent a house, to have a place to live, right? They are far more concerned than homeowners because they have not locked in their rate. The rent is always rising and it's always adjusting upward. And as you know, and I've said it many times, it's going up a lot higher, folks. Yes, I know. The surveys for rents are really misleading. Why are they so misleading? Well, because they're mostly multifamily housing surveys. I mean, think about it. The vast majority of you listening to this podcast, you are investors. You own rental properties. And I'll bet, and listen, I can say in my decades of investing, the only time someone ever asked me about these properties if they're vacant or occupied, and that is every 10 years when the Census Bureau reaches out to ask those questions if they couldn't find someone at the house when they did the census survey, right? If they couldn't find them, they would try and track down the landlord and call me and say, hey, is this house vacant? Is it occupied? What's going on here? I have had like 2 of those calls in decades, right? Nothing even then, right? But nobody calls you. I mean, folks, if you're watching this on YouTube, comment below. And I know on the podcast you can't comment below, but you can reach out to us and let us know. Go to jasonhartman.com/ask and just let us know if you ever got surveyed on what your rents are for your investment properties, for your houses that you own, right? That you rent out. I bet you never got a survey. I never got a survey. Okay. But apartment owners, institutional apartment owners, where they've got 200, 300, 400 units in an apartment complex, they get surveyed all the times by these research firms that survey rents, right? You know, these research firms, they have gumshoe people that go out and they visit apartment leasing offices. And they ask the leasing agents, hey, what's available? How much are these units? How many square feet are they? You know, what amenities do they offer? They do these big elaborate surveys, but they don't do the surveys on single family homes. Why is this meaningful? Why am I telling you this? Well, here's why. Because you're seeing in the news that rents are starting to decelerate. Now, they're not really softening yet, but I think they will. But just remember, what rents are they talking about? They're talking about rents on the largely overbuilt multifamily housing sector. The single family home sector is not the same animal. And, you know, like an Animal Farm, some animals are more equal than others. George Orwell. By the way, did you know that's not his real name, George Orwell? Yeah. That's just a nom de plume, pen name, right? Okay, so the single family home rental market is not the market that is getting surveyed. That is the apartment market. And these two are quite different, but whatever. Anyway, that's that. Now, we do have many more institutional players in the game now. We have Invitation Homes, American Homes for Rent, all these other big giant landlords that own thousands and thousands, tens of thousands of single family homes. So you can bet that these surveys will get better over time, and they will start to include more single family homes. But even with all of the institutional investors that really never played in our market before in any significant way until the last several years, they're a drop in the bucket. There are about 18 million mom and pop owned single family homes in the country. And the institutional landlords, it's hardly anything. It's a big figure compared to what it was, which was almost non-existent. But in the overall scheme of the single family home rental property market, they're still just a drop in the bucket, nothing significant. So this is important to understand, and much bigger issue for renters because they don't have the benefits you have. And this also is very indicative of what will continue to happen to the concentration of wealth issue. As wealth becomes more and more concentrated and most people move down the socioeconomic ladder. Very bad for society, bad news. I don't like it, but it's the world we live in. And we just want to help you be on the other side of that trade. So you're moving up the socioeconomic ladder, or at the very least, you're keeping your spot and you're not moving down like so many other people are. Look, economics is a relative game, as I've said many, many times. If you can just stay where you are, even if you don't advance, in a world where so many other people, the vast majority of people are drifting backwards, which they are, sadly, you are doing better. As a relative perspective, that is absolutely the case. Okay, what else? Inflation. Gosh, who knows? We certainly talk about inflation more than enough on this channel. But I wanted to talk to you about a new thing, another aspect. Well, it's not a new thing, but we haven't talked about this before. Maybe we've talked about it, but it hasn't been any real thing. And that is this. You've heard about the CPI, right? The Consumer Price Index, the most widely used measure of inflation. I call it the CP lie. It's like Bill Clinton, a good lie guaranteed, right? I remember a buddy of mine gave me some Bill Clinton golf balls years ago when he was president, and I was much more into golf back then. because I guess my tolerance for frustration was higher when I was younger, right? And the golf balls had a picture of Slick Willie Bill Clinton on them, and it said a good lie guaranteed. So the CP lie, obviously totally understated measure of inflation. But we also have the core rate, or headline inflation, right? The core rate especially is interesting because that one strips out food and energy. We've talked about that many, many times over the years. So they mislead us into making us feel inflation is lower because they're stripping out food and energy in that equation, right? But I wanted to talk to you about this one today. And this is the PCE, Personal Consumption Expenditures. And I got this from our friends at Investopedia, which, by the way, is a great website. Just be careful. The ads on there will talk you into putting your money in the stock market, the modern version of organized crime. But this is interesting. So let me just share with you a little video from our friends here at Investopedia. I thought this was a good explanation, and here we go.
Personal Consumption Expenditures, or PCE, is a measure of price changes in consumer goods and services. The Bureau of Economic Analysis and the Department of Commerce published the PCE report. It's one of two broad measures of price fluctuations and consumer behavior in the United States. The other is the Consumer Price Index, which measures the weighted average price of a basket of consumer goods and services.
That's the CP lie.
Shows how much households are spending and what they're spending their income on. While the CPI follows a fixed basket of goods and services, the PCE accounts for changes in consumption based on the idea that if a good becomes too expensive, consumers will use a cheaper alternative.
So there you go. Remember, I've taught you over the years about the three major ways they manipulate the consumer price index to make us believe inflation is lower than it really is. Weighting, substitution, that's what they're talking about right here, substitution, and hedonic indexing. So substitution, a total scam. We don't want to substitute. People are only doing that out of necessity because inflation is so bad. They'd rather not substitute. Listen to their example on substitution here.
When steak gets too pricey, consumers may substitute hamburger, for example.
So steak is too expensive, so you're going to have hamburger. I always use the example, if the price of beef goes up, everybody will, switch to chicken, right? But maybe you think chicken's a dirty bird. You don't want chicken. And so that's substitution, weighting, substitution, and hedonic indexing.
The PCE measures data pertaining to services, such as education or entertainment. It also measures durable goods, such as cars, appliances, and other items that last for a long time, and non-durables like fuel. Usually, the PCE reveals a lower inflation rate than the CPI, but it is a predictable report that bears little impact on the markets.
All right, so I hope that was helpful. So that's just a different concept that I thought you should be aware of. I just wanted to share that with you real quickly. No big deal there. Now, another thing, and this is just as I predicted back in about March of 2020. And Lisa shared this in our Empowered Investor Pro group, and I thought it was interesting. It shows you over the years the percentage change of renters in urban areas, suburban areas, and rural areas. And this is pretty startling. I predicted this would happen, both for home buyers and renters, just movers, just people in general. But look at how startling this is, really, okay? So the makeup in 2018 for urban renters, 44% of renters lived in urban areas, 44% lived in suburban areas, and only 13% in rural areas. Now, jump to 2022. Only 32% live in urban areas and 52% live in suburban areas. That is, statistically, that is a shocking, huge tectonic shift. And 16% in rural areas, that's up 3%. But just a huge difference. To go in 4 short years from 44% of renters living in urban areas to only 32% of them. And in suburban areas to go from 44% 4 years ago to 52% today. That is truly shocking. And guess what? Most of you, if you're following our plan and the plan that I've outlined over the last many, many years on this show and at our live events, we got another one of those coming up, don't miss it. You are investing in suburban areas. You're not investing in urban areas, so you are winning big time with this trend.